everyone, and welcome back to another episode of Financial Minds Meet the Experts. If this is the first time you're seeing this podcast, I'm Jaime Agostino, your host. On this show, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today on Financial Minds Meet the Experts, we are talking about the state of the economy with Fred Eisel, Chief Investment Officer at Vizo Financial, and Tim Sustak, Chief Credit Officer at Vizo Financial. Gentlemen, welcome back. This is the second time I've had you guys on the podcast to talk about the economy. So thank you so much for joining me. I really appreciate it.
Thank you.
Yeah, thanks for having us. Good to be here.
All right, so let's dive in. So Fred, we just had the Fed raise rates 75 basis points. Do we feel we are currently in or moving towards a recession? And how does the Fed's raise impact us?
First part of the question, are we in or going towards a recession? That's the million-dollar question everyone's trying to answer. In my opinion, we are not currently in a recession. This economy has been running extremely hot here for the last couple of years since the pandemic. The pandemic began, we thought the economy would really kind of falter, and it did. When we shut down the world essentially for a few months there. But since then, the consumer has had incredible demand. We've been spending a ton of money. We're still doing that. So we're not in a recession currently. Spending has come off a little bit. The housing market has changed a little bit. So we're not in a recession. I think we're fine. Are we heading to recession? That's the big question. The concern is the Fed has to get control of inflation. And the way they do that is to raise rates aggressively, which they're doing. And because they're kind of late to the game, as we talked in the last podcast, last year the Fed said inflation was transitory. Tim and I did not agree with that. And everyone kind of didn't agree with that. The Fed admits they were late to the game. So they have to raise rates aggressively this year to get ahead of it. Will that put us in a recession? That's the million-dollar question. I am on the side, I don't think so. And if it does put us into recession later, it will be shallow. Later, I would say sometime in 2023, not that I have any data to kind of back this up on, but I think the consumers are still in good shape. If a recession does happen, I think it's sometime in 23 to be shallow. Your second part of your question, the Fed's raising rate aggressively. How's that impacting us? You'll see that and are seeing that in the housing market currently. The Fed has talked about raising rates, so the market rates have changed upward. Mortgage rates are typically based off the 10-year Treasury. That rate has moved higher just based on what the Fed has said they're going to do. Now that they are actually changing rates aggressively, the 30-year mortgage went from around 3% earlier in the year to over 6% I saw yesterday. So that has definitely very quickly kind of cooled the housing market down considerably, which everyone agrees needed to be cooled down quite a bit. So hurts the consumer if they're looking for a house. Rates are a lot higher. That means your house payment's a lot higher. But at the same time, home values really got out of control here for the last year or so. Very difficult to get a home anyway for those folks who are trying to get a home. So those higher rates are going to make it a little more expensive, but really cool demand. And most people believe that will cool the house price appreciation and pricing. It would be shocking if home pricing come off a little bit just because of the lack of demand. So you're going to see that in housing. We're already seeing that now. You'll see it in higher borrowing rates for the consumer, whether it's autos, credit cards, things like that. If you're a saver, you may also see that in your money market accounts that you're crediting your CDs. You may start to see savings rates increase as well. So it depends on what side of the equation you're on, what you may see. So, recession's the million-dollar question. That's why the market's so sensitive. That's why you see the stock market kind of really struggling. Most people in the market believe we're going to recession because the Fed has had to be so aggressive in inflation, but we shall see.
All right. Well, Tim, what are you feeling? Do you feel an aggressive Fed will lead to a recession?
I think it's certainly a distinct possibility. I agree with Fred. I don't think we're in one now, but I think it's very possible that an aggressive Fed will lead us into a recession. How deep is anybody's guess? But I think the Fed is not afraid of pushing us into recession. they've made it very clear that their primary goal is to fight inflation. Chair Powell just talked, I believe, this morning at a Fed conference and basically said their commitment to restoring price stability is unconditional. And in his press conferences, he has not shied away from the idea of, recession. So nobody wants to tank the economy for sure. But if a shallow recession, as Fred described, is what it takes to tame inflation, then I think the Fed's certainly willing to go there and push us there if need be, because they're committed to pushing inflation back to their 2% goal, whatever it takes, I believe. So
okay, well then, based on that, sorry, go ahead.
I was going to say on top of Tim's discussion, he's right. The Fed's very comfortable putting us in a shallow recession. It's not the politically correct thing to say, but given how hot the economy's been for the last couple of years, you see that in supply chain issues. We kind of need to be put in a small, shallow recession to just kind of cool our demand on that side to really help on the supply chain side. So, which is mentioned in the past, you have unemployment at 3.6%. That means 97% of folks are working. So if you go to recession or a slight recession and unemployment goes to 3.6 to 6%, let's say, that still means 94% of folks are working. It's not great for the 6% that are unemployed, but inflation impacts everyone at every income level, retirees or working. So the Fed needs to control inflation. If that puts us in a recession, I think they're good with that. The market doesn't like to hear that or say that, but we haven't really had a recession since the financial crisis. We had one when the world shut down in March 2020, but this economy's been running hot since the financial crisis 10, 12 years ago. So a shallow recession here to cool off housing and some of the consumer demand is probably actually what we need. And to Tim's point, the Fed's going to control inflation, and if it puts in a recession, so be it. That's probably needed actually at this point.
All right. So from listening to the two of you, it kind of sounds like, you think the Fed raising rates will be able to tame inflation. Would that be a correct statement?
Well, I think you have to, if we're going to go that, I think we have to throw something else in there. And that is a fact. And Chair Powell talked about it a number of times in his press conference on Wednesday. And that is the fact that many of the things that are causing inflation are out of the Fed's control. The Fed controls the demand side with rates. It doesn't control the supply side. So all of these things out there that are contributing to amping up inflation, supply chain issues like microchip shortages and autos, the war in Ukraine, pushing commodity prices and energy prices. I mean, they don't control any of that. And there's nothing they can do with monetary policy to change that. So I don't think it'll be for a lack of trying. Can they tame inflation? I think they need some help. They need some help from the supply side to do it in a graceful manner and to achieve that nice soft landing that they want to achieve. Because I think if it's all about just squashing demand and they don't get any help, then I think that makes it tougher to have a nice soft landing. So.
All right. Well, since you kind of commented on supply chain, Fred, when are we going to see supply chain issues decrease? I'm looking to finish my basement. It's going to cost me an arm and a leg at this point. When is that going to change for me?
Another $1 million question that nobody really has an answer for. Kind of to Tim's point, depends on what you're talking about. Are you talking about lumber? You're talking about chips, microchips. So if you're trying to find lumber prices to finish out your basement, all right, you're going to finish that out, put some studs up, some drywall. Lumber prices have fallen considerably, even kind of prior to what's happened here with the Fed. So to stud your walls and to put some drywall up, that's kind of getting back to kind of a more normal level. And as the demand for housing kind of slows because of higher rates, that's not going to be so bad. Now, you're putting a little wet bar in, put a little refrigerator or some microwave or something else in, finding that little mini fridge or finding a larger fridge or some other type of appliance still may be a challenge because you have the microchip issue. When does that get fixed and repaired? Nobody really knows because a lot of this stuff is coming from overseas, from other countries that are still battling with some COVID issues, still trying to find supplies to build these chips depends on the company. Some of these companies have really done a good job since the pandemic to, rather than outsource their chips from one country or one company, over the last couple of years, they've said, that may not have been the smartest move. We're going to outsource our chips to 3 to 4 different companies, and those companies are going to be diversified throughout the globe. So if there's an issue in this country with COVID or some other geopolitical event, we can get our chips from another area. So some providers have done that, others have not. So if you're dead set on a Bosch dishwasher, let's say, that you're going to put down in your mini fridge, that may be tougher to find. My son was looking for a new dishwasher here in the spring, and they have the GEs, they have some other type of things. Bosch has not been able to get into the stores since the pandemic for whatever reason. You're starting to see Bosch dishwashers come back into the market. So somehow they figured that out. So that's a tough question to answer, because it depends on the producer, the product, where they're getting their supplies. To Tim's point earlier, the Fed can't fix that. They can fix our demand and slow it. So as the slowing of our demand continues for the remainder of this year and the next, hopefully sometime in early 2023, you'll start to see the supply chain get fixed. But you still have issues at the port, and all these ports trying to get cargo ships unloaded. There's a lot of the cargo ships are delayed. There's still a lot of that logistical stuff that's really still kind of messy. And that's just going to take a while to kind of improve, because it's going to take a while for us, the consumer, to slow down our demand. And that's probably going to happen the latter part of this year with Fed increases, kind of people worried about gas prices and confidence of inflation being controlled. We may slow down our spending, which kind of gives time for the supply chains to increase. So I don't see that happening anytime this year, but I think as the year progresses and into early next year, I think we'll slowly start to see supply chain improve. You go past your car dealership, they may have some more cars available, but I don't think spring of 23 it's going to be a full lot of cars either. So it's going to take some time. We've had 2 years of absolutely incredible demand globally, and globally trying to battle COVID in one way or another. So this is not going to be something that's going to be quickly fixed in the next couple months. It's going to take some time this year, probably most of 23, to just kind of get things back to equilibrium. To Tim's point, that's going to take the Fed, it's going to take some fiscal help, and just a whole lot of changes geopolitically throughout the world. It's going to take some time. I think 2023, it starts to get closer to normal, but it's still going to be a while.
Okay. Tim, you feel the same way that regarding the supply chain?
Yeah, absolutely. I mean, I agree with Fred. It's going to take some time to sort out. Just as an example, you watch the auto industry pretty closely, and we've been hearing ever since the chip crisis began. I think folks thought originally it'd be fixed sometime this year, and then we went to 23. Now talking with folks that are in the industry, the thought is, well, yeah, it's probably 24 before we get back to what we think is more normal. So this thing keeps getting pushed out longer and longer as problems continue. So yeah, I agree. It's going to take a while for things to get sorted out, but hopefully we get some incremental relief along the way.
All right.
And something not dealing with the supply chain. I think it's just the attitude and mentality of us as a society. We were at a meeting in Virginia earlier this week, and we were talking to the woman who manages the hotel, and they're kind of back to normal, so to speak, business. Pretty close to what it was pre-COVID, not 100%, but kind of close to pre-COVID. But she said at their hotel, and just generally in the industry, they believe it's going to take till about the fourth quarter of 23 for that industry to kind of return back to normal. They're still having challenges significantly of trying to find and retain help. They're trying to find internships to fill for folks that want to get in the hospitality industry. They can't find folks that want to do that. So just in the hotel industry, it's not a supply chain issue, but that industry with regard to folks traveling, feeling comfortable to travel, sending groups to a conference. In pre-COVID, you may have sent 5 people from your management team to a conference. Today, we'll send 1 or 2. And you know what, if you offer something virtually, we'll probably do that. So, in that industry, you're talking late 23 till they feel it's back to kind of a normal. I think that's just generally the case for everything. I think it's going to take this year and then 2023 to just get things back in equilibrium. So I think next year is going to feel a lot like the same, like it does now, that doesn't feel great. And I think 2023 we'll get a better read. I think we'll get a better read later this year, but definitely 23. How is the Fed doing taming inflation? Is inflation under control? How bad was it? Will they put us in recession or not? So I think late 23, most industries hopefully will start to feel like they're getting back to normal. We may be in a recession at that point, so that normal may not be pretty, but maybe finding staff and getting back to normal is still going to take some time, probably late into 2023.
All right. Yeah. I've been at several events later, for the credit union industry, and attendance is lower. I mean, it's definitely something we're seeing just in our industry in regards to people wanting to travel and be in large groups. And obviously there's an impact then to the hospitality industry as a result.
Yep.
So
Yep.
Will higher interest rates impact lending in the credit union industry or the demand for loans? Fred?
Hard to say. I think, and Tim can probably speak more to this. What we're seeing is loan demand at the credit is still sky high for most credit, not all credits, but the ones that are lending well are still lending at a very high clip. Now, is that because the consumer's confident and still borrowing and spending because things are good, or are they borrowing now because their fear of rates are going much higher than they already are? I think higher rates will definitely slow down lending. Obviously, if you're large, if you're big in the mortgage game, that's going to slow considerably. I was on the phone this morning with a guy whose wife was a mortgage closer, and I say was because she was just laid off this week. She worked for a mortgage company. They probably overhired during the last couple of years because mortgages were through the roof. Well, they just went through their fourth round of layoffs, and she was one that got laid off. The company's probably going on their way out to being closed, he believes. So if you're in mortgage lending, you're going to see that loan demand really, really slow down because you're not going to see as much origination, and you're definitely not going to see refi activity. That was kind of the two-prong thing. If you were in mortgage lending for the last couple of years, you had a ton of demand on mortgage origination, folks buying a new home, but then a ton of refi activity of folks trying to just get down to that low rate of 2-3%, wherever it was in the last couple of years, extremely historically low rate. Well, that game's over. If your 30-year mortgage is 6%, you're going to slow down the origination considerably, and refi activity is going to disappear to nothing. I mean, that game's over. So mortgage lending is going to slow considerably. Auto lending, I think auto lending will still stay decent even with higher rates because the age of the car out on the road right now is getting older, and folks do have a demand for new cars. They just can't get the car. So when the cars are more available with the supply chain issue being fixed, as we talked about, I think slightly higher rates won't kill the auto industry and the auto lending market. The credit card demand will be there. Personal loans probably will be there. Home equity line of credit, HELOCs and home equity loans, I think will be there. That will increase. So first mortgages will slow down given rates, but home ec and HELOC loans will increase. We've already started to hear some credits saying it's increasing dramatically because folks are sitting on a ton of equity because their home value's gone through the roof. And if they're going to finish a basement like yourself, we'll spar from ourselves because their equity now in the house is much greater. So it depends on the loan, depends on the credit union. I think in certain pockets, the lending will slow dramatically because of the rate. I think in other pockets of the balance sheet, lending will probably slow down a little, but stay fairly solid because the consumer is in a good position. They have good value in their home. If they're still working, things are good. They still will borrow for that car or some other things around the house. So I think it depends on the loan product and the membership, but I think it'll be fine.
All right, great. Tim, what are your thoughts?
Well, I mean, I don't have a whole lot to add. I think Fred hit it spot on. I think the key is exactly what he said there at the end. It's going to depend on the credit union, the loan product, and kind of the timing of this thing. Because just anecdotally talking to some credit unions now, I mean, loans are on fire. Consumer type lending. Certainly, mortgages have slowed up as for all the reasons that Fred indicated. But credit unions are just turning loans out as fast as they can. On the consumer side, I think a lot of that is when the Fed starts to talk aggressive, it gets people off the fence and deciding if they were going to do something. Well, better go get the money now, and talking to some credit unions, that's exactly what they're saying is, People are coming in to get the money while it's still relatively cheap anyway to what it could be, right? So I think it's certainly amped up some loan demand now, and I think that certainly does fade a bit with interest rates rising. I mean, you tack another % or two on there, you might not be able to afford the car. Maybe you decide to keep it another year or two. Maybe you put off a project, what have you, in hopes that you get some relief later. But then on the flip side of that is, as people spend down balances and if inflation doesn't get squashed quickly, then, people start to do a little more on a credit card and things like that. So I agree with Fred. I don't think it's going to completely go away. Credit unions aren't going to be able to make loans, but I think it's going to ebb and flow in different parts of that lending portfolio, depending on what's going on at the time.
All right. I was one of those people. I locked in last time before the rates increased for my home equity because I knew where the rates were going. So I was one of those on the fence that made a decision quick.
Smart, very smart. And what we're kind of the recency bias, as they call it. We're always looking at where we're at today, where we're going, and man, how are we going to lend? How are we as a credit union going to lend going forward with these rates where they're at today? Well, 2019, the Fed was raising rates. They raised rates 2017, 18. They raised rates, had to come off a little bit, but the overnight rate was going up. The 10-year Treasury in 2018 got to be about, I'm just pulled up my graph here. November of 2018, the 10-year Treasury is 324. Today it's about 323. So yes, during the pandemic, the world changed and the 10-year Treasury went to next to nothing. And it gave us mortgage rates of 2.5%, 3%, just insane borrowing rates. But prior to the pandemic, credit unions were lending, doing well, with rates that were very similar to where we're at today. So, and they lent well post-financial crisis, 2008, 9, that was 10, 12 years ago. Borrowing was decent. Their loan demand was decent for many credit unions. Lending was there. So the world we're living in, yes, rates have gone up. And are we having a recession? Is inflation out there? Yes, a lot of things spinning around here. At the end of the day, these rates today are getting back to normal where they should be. And consumers will still borrow. A consumer's still going to want to buy a house. A consumer's still going to fix their basement and get a home ec loan. You're still going to want a car because your car is old and you want to kind of get a new car. So, we've come out of this 2 years of pandemic and we think that should be the world. This was a manufactured kind of recession. We had a ton of fiscal stimulus. We had a ton of monetary stimulus to get rates to next to nothing and add a ton of liquidity to the market, which now we're trying to get out of that. And it's going to take some time. But as we get out of it and get back to normal, rates get back to normal, consumers are still going to borrow, not at the insane level on the mortgage side as we have. It's going to slow down to a more normal place, which it should be. So rates today are about where they were. And I think the credit union, if they're well positioned and have good loan programs, they'll see their lending still be fairly solid. Not at the levels they may have seen, but probably back to more normal average levels.
All right, thank you. All right, my last question. Tim, I'll start with you. July, will the Fed raise rates by 50, 75, or 100? What are your thoughts?
No 200 on there?
I did not put 200.
No, just kidding. Unless something drastic changes, I'm going with 75. I just don't think you talk the way the Fed has been talking about their commitment to squashing inflation and bringing it back to 2%. And if nothing drastically changes between now and the July meeting, that you don't do another 75. But I think, everybody likes to talk about what they think is going to happen. Everybody's got an opinion. But I think what we need to remember through all the talking heads out there that, think they know what the Fed's going to do is, and if you listen to the Fed, they tell you all the time, look, it's data dependent. We don't know what we're going to do until we get there, until we see the data that's been presented to us, talk about that and make a decision. In Chair Powell's press conference, he had to explain, hey, last press conference, he pretty much told us 50 and 50. Now you hit it with 75. What happened? And he explained it. He said, look, it's pretty rare to get significant information kind of just before the meeting in that blackout period where they can't talk publicly about things. But he said, look, inflation data surprised at the upside. Some indicators of inflation expectations had notably changed. And we took things into account. We took the data into account, and we made the decision we thought we needed to make. So I think it's important for everybody to remember that despite what's being said, the Fed's going to look at the data and they're going to do what they think they need to do, regardless of what everybody's saying they're going to do. So I'm going 75.
All right. Fred, 75?
Tim's crazy. I have no idea what he's coming up with there. But
it's not the first time I've been told that, but what are you going to do?
But I completely agree with him. I'm with him. This is such a moving target. It's almost weekly. It wasn't that long ago, probably a couple weeks ago, that we would have never thought the Fed would move 75. That was a month ago, we'll say. That wasn't happening. They moved rates in May, 50 basis points. And the question was, would you do 75? That's not something they're thinking about. We'll talk about it, not something we plan on doing. That was May. But the data comes out, and as we've talked about in the past, the Fed is behind big time. Everyone knows it. The Fed knows it. And when the CPI came out a couple of weeks ago, it still showed inflation extremely high. The Fed says we got to get ahead of this. Remember, they've been, as Tim has said, they've been very transparent. Why the markets, the professionals that know everything, get so shocked when the Fed says some things or does some things, it blows my mind. They have said they're going to be aggressive and get inflation under control. Everyone knows, the Fed knows they're behind. And when the data comes out and inflation's running a little hot, market rates have gone up very quickly. The Fed can only catch up so much. But when it comes out and it's running hot and they move rates 75 basis points, that's what they need to do. That's what the market wants them to do. Why they're shocked, I don't know. But they put 75 basis points in play in July because they've just done it here in June. If the data continues to run hot and inflation still looks like it's kind of elevated, I agree with Tim. I think 75 is definitely in play for July. I think it's more in play only because they've proven they could do 75 here. Because as we led up to the Fed meeting here last week, or this week, I guess it was it last week? I don't even know. I wasn't tracking time here. But, again, a week or two ago, it was 50. And all of a sudden, leading into the FOMC, it was 75, maybe 100. I don't know. Definitely 70. It's going to be 75. If the Fed really, really wants to shock the market 100, then they come in at 75. So it wasn't that big of a shock. So I think in July, for them to do another 75, not a big deal because they've already done it. And they've also said in a longer term projection, they have rate decreases in a longer term plan because they've said too, if we overcorrect, we'd rather overcorrect and raise rates too high too fast. If that's the case, we will back off a little bit, but we got to get inflation under control. That means being very aggressive up front as we see the economy improve or maybe head to recession, but inflation's coming down and it's easing up that supply chain issue. We'll back off. We'll cut rates in the future. But in the meantime, we're behind. We're going to be aggressive. I agree. I think 75 is without a doubt in play for July. And then they just kind of see and look at the data. I still think 50 September, they maybe back off and do 50 sometime in December, but they're going to continue to move rates very aggressively for the remainder of this year. No doubt about it.
All right. Well, thank you. You guys heard it here. We're looking at 75 in July. So thank you both so much. Really appreciate the time and your commentary regarding the state of the economy. One of the things I want to mention, Vizo Financial, our biggest financial event of the year, is coming up September 14th and 16th, 2022. And this year, it's in person at the lovely Ballantine Hotel in Charlotte, North Carolina. Fred just gave me the agenda the other day. We are working on that registration site. Come to the conference, great conversation with credit union peers, great education sessions. CPE credits. The event is sure to please. Mark your calendars again, September 14th and 16th, and keep an eye out for information which is coming soon, as well as the registration. Thank you guys so much. As always, thanks for listening, and make it a great day.